in today's video, I'm going to be going over pairs trading. This is a hedge fund strategy. I thought about making this paid, but I'm just going to give it this specific strategy for free. If you want to know any more about strategies kind of like this, you can go check out my Delta Neutral course, which covers a strategy similar to this. Let's dive in. All right, traders, let's do it. So what pairs trading is basically when you take two different futures assets or perpetual assets. We go long on one coin and we go short on another. Now I've covered this before, but in today's video, we're going to cover this to a much deeper depth. And I'm also going to show you guys a live trade that I had taken, and I'm still in that trade right now, and how you guys can make trades just like that, okay? So the first thing that we want to do is find two correlated futures assets that you want to trade. So the easiest way to do this, to find the correlation between two coins, is the correlation coefficient on TradingView. And that's something I have set up here. I know that there's a lot going on. Ignore this, that will be covered. But look down here. This is comp. This is comp on FTX. It's a perpetual asset. But right here, unfortunately, you can't even, let me see if it tells you. Yep, here you go. This is the correlation that comp has to Rune perp on FTX as well. And this is on a 4-hour time frame with a period of 20. So as you can see, they're pretty highly correlated, more highly correlated than most. And that was the coin that I used for today's video. So that's the first thing that you want to do. The second thing that we want to do is to go to TradingView, and you want to divide one asset by the other to get a ratio. Okay, so here's really the crux of the strategy. The first thing you do, guys, you find two coins that are highly correlated, or two coins that you suspect are highly correlated, and then you test that correlation out. You're then going to divide one asset by the other so we can actually analyze a ratio of it over time. So to show you guys what that looks like, I will put this guy, oops, no, nope. I'm just going to click that, and that should work. Perfect, yeah, that does work. So this, ignore the white line. I mean, that will be explained soon, but what you're looking at is comp perp divided by Rune perp. So these are the same two coins that we did a correlation, coefficient of before, and this is how that pairs ratio has traded over time. Here we can see that comp was very expensive relative to Rune here, whereas Rune was was doing quite well here relative to comp. That's because this is the numerator and this is the denominator, which means that if the pairs ratio goes down, that means one of two things or both things are happening. If the pairs ratio goes down, that means that comp is probably falling in price, or Rune is probably rising in price. Rune rising in price will cause this pairs ratio to decline. Okay, so this is what that looks like. You can also do this by just going to FTX in a way that I'm going to show you guys soon. You can get any two coins. I'd recommend not going for the large caps like Link, Ethereum, Bitcoin. I don't think this is something you want to do with that. This is something you more want to do with those middling market caps, in my own expertise of how this system works. So you do that, and you can divide one asset by the other. Then we're going to analyze the pattern of the ratio, which I just showed you, but we can go a little bit deeper. We can see that it's been pretty cyclical. I can see it just bounce off these lows every single time. Really, this ratio of about 180, meaning that one comp perp is worth 180 Rune perp. Hope that makes sense. At this price, one compound perp is worth 180 Rune perp. That's the exchange. Now, what we would do here, what we'd want to do here, if we saw this cyclical kind of ratio, is what? I'm going to tell you guys the answer, but I'm going to give you guys 5 seconds for it, of course, like I love doing. You would want to buy comp perp and short Rune perp, because if you long comp perp and short Rune perp, you're essentially longing this pairs ratio. So if this price goes from 180 to 200, then you're going to make a profit of about 11% by my math, 11.1%. So, well, how much money would that be? Well, let's say, guys, that we have $10,000 US. We put a $10,000 long on comp and a $10,000 short on Rune. We do this at 180. We get the pair at 180. We long the pair at 180. Then the pairs ratio goes up to 200, which is 11% profit. The profit of that would be 11% times 10,000, which would be about 1.1K. Okay, so we'd make about 1.1K by doing that. All right. And yeah, like I'd said before, you're either going to go long or short on the pair. But what you want to do when you do this is use the same USD notional size on both. So what I mean by this is, let's say that that coin X, which in this case is Rune, costs 10 USD, and coin Y, in this case Comp, as a kind of example, costs 500, and you're looking to enter into a 1,000 USD pairs trade. Well, then what we want to do is to either long or short 100 of coin X, and then long or short 2 of coin Y. So if we look at the pairs ratio, just an example of X divided by Y, and we believe that that ratio is going to rise, well, then what we want to do is to long 100 of coin X and short 2 of coin Y, because that would be 1,000. I hope that makes sense. Just 100 times 10 and 2 times 500, and that would be longing the pairs ratio. So now let's talk about something really important. Why do we even do this? Why am I going to the weeds with kind of doing this? It's all about the correlation of BTC and the overall cryptocurrency market. The reason why a lot of hedge fund managers don't just long one asset or just short one asset without hedging it is because it's very risky to do that, and hedge funds want to preserve capital, as should you too. So the benefit of doing these kinds of pairs trading is that you can hedge out BTC correlation. Because if you have two assets, and let's say you long him and you short him, and both rise, as long as the one that you long rises more than one you shorted, you make money. But let's say everything dumps, just everything falls apart in crypto. If the asset that you shorted dumps more than the asset that you went long on, you make money, right? And that's kind of what I describe here if you want to pause the video and just go read that. Therefore, a pairs trading kind of strategy where you take two different perpetuals or two different futures contracts can be attractive because you're limiting the amount of factors that affect your positions, such as BTC correlation and cryptocurrency market risk. Okay? Now let's talk about really the main crux of the strategy, the probably most attractive part by far, funding. What you want to do is to analyze the funding patterns of both coins using Coinalyze. So the way that you do this is, let's say that we are looking to do a strategy of, I want to go to FTX, and I'm looking at potentially going long on Ample because the funding is quite good on Ample, and then maybe hedging that Ample. Let's say that I find that DOT and Ample are like just highly correlated, right? So I'm going to short DOT and I'm going to long Ample. What you want to do is then go look at the historical visual funding rate. To do that, you go to Coinalyze, we go here, and I'm going to go put this on the 1 hour time frame when it does load. So this is Ample. It has had very, very, very negative funding, as you will soon see. So if you look at the funding over time, I mean, it's just gotten from decently positive to like negative 0.2 per hour. So Ample's been very, very negative funding, and you can see that the price has risen quite an amount. So it actually does become right now quite attractive for going long. But now let's go look at DOT. So we know that this funding kind of pattern is primarily wanting us to go long, right? Going short on this could be problematic. DOT. Now let's go look at the DOT funding. Oops, sorry guys. The DOT funding patterns, that would be you. So now what I want to look at here is, let's say, guys, that because of the funding, which I mentioned here on this little Ample DOT strategy, I want to go long on Ample and short on DOT. Well, what we're doing here is finding out what the funding's like for Ample and DOT to see if that's an attractive strategy at all. So on DOT, yes, it actually does turn out that the funding is positive. Well, let's go look at the pattern of how positive it's been. DOT's been decently consistent. It's been positive a fair amount. So what this means here is, from the simplest concept of this, if I find that these have a very high correlation rate, I could just go long on Ample and then just go short on DOT and then get paid funding every hour and then just hope that the ratio goes in my favor, right? But let's actually go put that ratio in. And the way that we would do that would be Ample perp divided by dot perp. Yep, let's go look. What do we got here? So this is exactly what I expected. Yeah, This is exactly what I expected. So we can see that the pair has risen quite an amount. And the reason that this pair has risen quite an amount probably is because longing this pair is quite attractive. And you can see that here, because if we were to go short on dot and long on ample perp, that's essentially longing this pair's ratio. So let's say that we take this exact trade. We short dot, we long ample because it looks great on paper with funding. You would be entering into a pair's ratio of longing at around 34.55, right? Meaning that if price goes here, if the pair goes up in value, meaning that ample increases more than dot, really, you make that profit of 7%, 10%, whatever. But if this goes down, which means that dot is outperforming ample is underperforming, then you would lose money, right? So that's kind of how that thing works there. So back to funding. So yeah, like a very simple strategy that you can do, even one that I've done, is just you long a coin with negative funding and you short a coin with positive funding. I'm going to give you guys a great example of that too, as the ratio between the two coins is typically heavily influenced by the funding rates of each. And I'm going to show that to you if it doesn't make sense. One other strategy that I thought of that's actually quite cool is, let's say that you find two assets, guys, and you really want to, you look at this pair here, and you say, I hate this. I actually really want to short this ratio. I want to short this ratio so bad, but I don't want to pay that funding, because if I go short ample, I'm paying 0.2% per hour. Ouch. And if I long dot, I'm paying 0.01% per hour, because this pays shorts and this pays longs. So if you want to short this, here's a little trick you can do. You can use the expiring futures instead. So what I mean by that is, let's take, you could do ample doesn't have one. But let's say you're looking at MTA perp versus dot perp, right? And you find that, hypothetically speaking, you are just really wanting to short this ratio. You want to short this ratio so bad. You've never wanted to short a ratio more. And you know that this funding, unfortunately, is very negative. It's going to hurt you if you short. This funding is very positive. If you long, it's going to hurt you. Well, what you can do is this. Watch this, and hopefully your mind is blown, or you're not just too confused at this point to be like, what's going on? Well, what you can do is trade the futures assets. You can see that the futures have a similar ratio. The other guy had a 1.22. This has a 1.2. And if I was to do the same exact thing, guys, if I was to short MTA 925 and long dot, well, what's going to end up happening is I'm not paying funding, because these are expiring futures contracts. So with this strategy, the benefit of it is you get to pick. Let's say that you really like the funding on one coin. You really like the funding on both coins. Well, then you can do the perpetuals. Then let's say that if the funding works out perfectly, you could, let's say this is negative, this is positive, you could long this pair because you're buying MTA perp and shorting dot perp and getting paid funding every hour. Awesome. But if you think that if you want to short this ratio and funding's against you, well, then you can take advantage of the expiring futures contracts that don't even have funding rates. I hope that makes sense, but that is a way you can actually avoid paying funding by just trading the expiring futures contracts. Just always remember when those contracts expire, of course, because that matters a lot. Here's an example that hopefully you guys are familiar with so far. So you look at coin X, coin Y, they're highly correlated, awesome. Let's say they have a 0.9 CC, a 0.9 correlation coefficient. Coin X has been just consistently underperforming coin Y. So coin X, coin Y, whatever. Therefore, the pairs ratio of X divided by Y has fallen over time. Because the price of X is going down, the numerator is going down, which makes the pairs ratio go down, of course. So coin X has had positive, let's just say coin X has had consistent positive funding paying you if you short, and coin Y has had consistent negative funding paying you if you long. So you enter into a short on the pair of X divided by Y, and you will profit from two things. You'll profit if the pairs ratio continues to decline. You'll also profit from funding if funding stays the same. Because if funding stays the same, then coin X pays you, coin Y pays you, and if the pair goes down because you shorted the pairs ratio, that pays you too. Here's what I did. I actually did this August 29th, so like 2 days ago, yeah. I went long on the pairs ratio around here, and I went long at an exact price of 222.75. Now, before I tell you guys the answer, if I went long on this pairs ratio, looking at this numerator and denominator, what does that mean? What did I long and what did I short? I went long comp perp, I went short room perp, okay? So I longed that and I shorted that. And that's what gave me this pairs ratio of 222.75. After I went long on comp and short on rune, I just did the average open price of comp divided by the average open price of rune to get me that entry point, to just tell me where I entered on this. And as you can see here, the pairs ratio went up 6%. So I did this with 1,000 USD each. So a 6% increase on a $1,000 pairs trade is $60. So far, this pairs ratio has paid me $60. But wait, there's more. So what's also happened is because I went long on comp, and lucky for me, I longed it a really good price, the funding got very, very negative, which was amazing, and it began to pay me something like 0.1% per hour. So I ended up actually getting an additional, I think, like 2% from the funding from this, just from the comp side, because you can see I went long and I got paid all this funding, so that's like an extra 2%. So that 6% is actually 8%, right? 6% from the pairs ratio increasing, awesome, in my favor. And then also we get that 2% just from funding, from comp, because it's been insane, really good funding. Also, I shorted Rune, right? I shorted Rune USD, and you can see that this has had positive funding paying my short, and this has made me, I think, maybe like 1%. So in total, I've made about 9%, or actually, no, I made more looking at the P&L. I made about a 10%, probably because I made probably around 2.5% on comp funding, 1.5% on Rune funding, and then 6% in the increase of the pairs ratio, which equates to about a 10% gain, which is about $100 profit from $1,000. Now, that I think is pretty cool and impressive, but to put it one step farther, let's talk about the margin that you need. So FTX offers you 101x margin, right? They offer you that much leverage. So because of that, you could theoretically, this would be dangerous, but you could theoretically take like, well, if it's $2,000, you could theoretically take like $40 and make $100 off of this. How? Well, you take that $40, and the first thing that we do is that we go long on comp with 1,000 USD. That is 25 times leverage with that 40, right? Cool. And then we do 1,000 USD short on Rune, and that is 25 times leverage on $40. So combined, we have 50 times leverage. And on that $40, because the pairs ratio went up and the funding's paid well, you would actually turn that 40 into 140 if you knew what you're doing with pairs trading. The only issue with that is that liquidation can be a problem. You will be liquidated if you try this kind of strategy if the pairs ratio goes really against you. So let's say that you enter in this pairs ratio like I did here, but then the pairs ratio went to 170, and you don't have enough margin to cover that loss from the pairs ratio. Well, then you're going to get liquidated or lose some money somehow. So that's really what the crux of strategy is, and I want to explain one more thing. Always make sure that the USD notional size of the two coins that you trade is the same. So if you long 1,000 USD on one side of the pairs ratio because of negative funding or just because you want to long the pair, and then you short the other guy, that has to both be 1,000 USD. You can't do one with like, you don't want to like long one comp and then short one Rune. That's idiotic because the price of Rune is like $5, but the price of comp is $230. No, that doesn't work. You'd have to do $1,000 worth of comp and $1,000 worth of Rune, and then you have your pairs ratio. This is a strategy that hedge funds have been using for decades. I've researched this strategy. Typically, actually, hedge funds do this in just all different kinds of markets, especially equity markets, where you take two stocks that are just highly correlated to the S&P, to the overall stock market. And we go long one and we go short another because we believe that the one that we long will outperform the one that we short. Now, in the stock market, you have dividends, but I don't think that they don't have funding rates like we have here, or things that pay you this quickly in interest. But the hedge funds do those kinds of strategies because in some sense, it's a safer bet. Because you have problems. If you long everything in the stock market and then your hedge fund sees all those stocks that you went long just dump in value 30%, you're going to have some massive issues and some calls from your investors, But if if you do the same thing where we actually do pairs trading and you short 50% and you long 50% and you short bad companies and you long good companies, and then the market falls out 30% and the bad companies fall to zero, well, then you actually might even have a profit because the ones that you shorted did worse, which is good for us, than the ones that you longed. Okay? So that is how you do pairs trading. You can do it with any two futures assets or futures perpetuals. Like you could do it with that, algo perp with XTZ, whatever. But do remember when you do this that you can actually do this on any exchange. It doesn't even have to be FTX. You could do this on Binance. You could do this on the Delta exchange. You could do this on a plethora of exchanges. Really, it's up to your own creativity. But like I always say, do your research. Research the funding rates. Research whether you should take the expiring contracts or the perpetual contracts. And if this doesn't make sense to you in any sense, then reach out to me. And then we'll talk it through, whether through a mentoring call or just in comments or just DMs, we'll talk this through. But this is a strategy that can help hedge out BTC risk. It is a strategy that can pay you in funding. And it's also a strategy that allows you to pick between two coins and just pick whatever one you think is going to outperform the other, or pick whoever you think is going to underperform the other. And that's pairs trading. With that, happy trading, and I'll see you in the next one.